In this section, I will cover the underlying dynamics of confidence and fear so that you can build a framework for understanding how to create a carefree state of mind when you trade. Okay, the next section that we're going to get into is exploring the dynamics of confidence and fear. In other words, what was from this morning and just a little while ago, not so much a little while ago, but especially from this morning, what's the primary problem? Why do we have so much of a problem, or what creates the problem in a trade-by-trade perspective? In other words, if I'm looking at the market, if my technical indicator gives me a signal to buy right now, okay, if I'm not predefining my risk, if I'm hesitating, if I'm jumping the gun, if I put my trade on and I want to move my stop, what is it that's going on right now? What's compelling me to make these kinds of errors? Fear. And what's behind the fear?
The possible negative mistakes that we've made in the past.
Okay, but that's good. Yeah, because you don't want to get tapped into being wrong, losing, missing out, all that pain. But remember, I said what was a universal characteristic of all humanity in terms of how we feel about our expectations being fulfilled?
Satisfaction.
Well, yeah, no, when they are. But what I'm saying is that it's because I'm expecting this trade to work. Okay, I want you guys got to get this. Okay, the reason why I'm having a problem is because I'm expecting this trade to work. This trade. It's not because I'm thinking that I've got a series of trades. Remember the pattern with flipping the coin? The pattern is that if I've got an edge, I'll give you another example. Let's say that I've got a coin that's weighted heavier on the tail side, so that it's going to come up on a percentage basis 65% of the time heads. And I get someone to take the other side of a bet where I get to call the flip every time. What am I going to do? Am I going to try to determine when tails is going to... 35% of the times tails is going to come up. I'm going to call heads every time. That's a pattern, okay? The way it relates here is that I've got a technical methodology that gives me winning trades, let's say 65% of the time. I don't know which of the next 20 trades or 25 trades that come up, I don't know which ones are going to be the winners and which ones are going to be the losers. If I'm going to trade my methodology appropriately, it really obligates me to take every single trade. I can't be picking and choosing my trades based on what I think is going to happen, because hopefully I've already established you don't know. And if you think you know, you're just making it up in your own mind. I'm going to repeat that. If you think you know, you're just making it up. Is everybody all right with what I just said?
Yes.
And so it obligates me to take every single trade that comes up, because I don't know which ones are going to be the winners and which ones are going to be the losers. It means that if I'm having problems, it's because I have a certain expectation about this trade, or about this trade, or about this one. So what if I'm expecting a random outcome? What if I change my expectations? Will I feel differently about it? If I change my expectations, will I feel differently about it?
Definitely.
Is there anybody in this room? Does anybody who trades? I don't think I've ever met anybody who trades who hasn't at least gambled at some point in their lives. Right? What do you expect when you put money into a slot machine and push the button?
Goodbye.
Good. Well, one of those answers was goodbye. I like that. What else? Loud. If anybody's going to say anything. What are you expecting? Really? On this one? Seriously. What do you expect? You know what you're expecting? You're expecting something to happen, right? You're expecting the wheels to turn. You're expecting something to show up. Now think about what I'm just saying. Because you know what? What I just said is exactly what I expect when I put on a trade. I'm expecting something to happen. I don't know what. But over a series of trades, if I do everything right, I'll make money. Because I'm managing my expectations on each one of these trades. I'm managing my expectations so that I do not have the potential to define and interpret these up and down ticks, the information the market gives me, in some sort of threatening or painful way. Because what I'm going to tell you, what we're going to get into now, is the effects of that. When you put money... What's that?
How realistic then is that 65% on your methodology?
What do you mean, how realistic?
It could be 70 or 80 or 50.
Go ahead. No, take the microphone.
How realistic is a 65% win ratio on your methodology?
I'm not understanding the question. How realistic is it?
Well, if you can't go by any individual specific trade, but you say over 20 trades, you can say you expect to win 65% of the time.
Correct. They're based on past performance.
Okay, but then again, looking at over any individual 20 or 50 sample, how realistic is maybe that 65% saying that that's a real number?
I'll find out. I don't know. I don't know. How will I know? How could I know? I'll find out. That's why you trade in sample sizes that are limited. In other words, I don't make an assessment of how well it's working until after the end of a sample size. If at the end of a sample size, I get a high enough percentage of winning trades where I'm satisfied, then I'll take another sample size. If I don't, then I'll find ways to tweak my indicators to improve my results. So if you're to say, how realistic is it? I have no idea of knowing what's going to happen in the future. And when you get right down to it, it is possible. Would it not be possible for me to start a sample size that trade won and end up where every single one of them was a loser? Am I going to know that in advance? And see, and that's where paper trading is so critical, is that by paper trading, you will get a realistic assessment as to how well your edge works. And people have no problem paper trading. They'll paper trade to find out if their methodology works and to gain confidence in it. It's the other part that they won't participate in, meaning that they won't take a similar exercise to see how well their own psychology matches up to what they need to do to be consistently successful. In other words, to set up an exercise. Paper trading is an exercise, is it not? It's an exercise in developing skills, in understanding your methodology, is it not? So wouldn't it be just as reasonable to set up an exercise to learn how to execute properly, so you manage your expectations?
What do you consider a proper sample size?
20, 25 trades. I don't think it has to be more than that. I really don't. If it's not working within 25 trades, then there's something you're going to have to change. Okay, so it's all about our expectations. When I put money into a slot machine, I'm expecting something to happen. If it comes up a loser, do I get all worked up about this? Does this tap me into my accumulated emotional pain of every time I've been wrong and lost in my life? I mean, look at it. There are people who trade and because of their expectations, make every error in the book and can't make consistent money. And the reason why is because of like I said, because of their expectations. And yet, if they put money into a slot machine, where essentially the only difference between technical trading and a slot machine is the fact that with a slot machine, you have to put your money in first and then wait for a pattern to emerge. With technical trading, you have to wait for a pattern to emerge and then technically put your money on the line. The problem is, because the way our minds think, we think that because the pattern emerged, that somehow or another it's giving us an edge on that particular individual trade. And there's just no way of knowing that. But over a series of trades, it does. So it's like technical analysis gives the individual the availability of being the casino. Technical analysis lets you own the slot machine because you've got the odds in your favor. The casino makes the slot machine available to us because they've got the odds in their favor. But to derive the benefit of those odds, you have to be able to execute properly. And you have to think about this properly. It is just a numbers game based on the odds. That means that you can't put an extraordinary amount of significance on each individual trade. Because if you sat and played a slot machine, you wouldn't think anything of it. If you played a dollar slot machine and you sat down with the idea that, you know what, I got $100 in my pocket, and you didn't win, you might have, let's say 10 times in a row you didn't win, you're still going to push the button. Because eventually you think, eventually I'm going to hit. Eventually I'm going to hit, so it's all right. You see, it's all right. Same thing here. This trade didn't work. Well, eventually I'll get a winner. This trade didn't work. Eventually I'll get a winner. This trade didn't work. Well, eventually I'll get a winner. Well, I don't know about this next one now. And that's almost always the winner. Now, if it turns out that your methodology has diminished in its, let's say, in its capacity to produce a winning percentage, because the underlying nature of the market is changing in relationship to this fixed formula, then, that's why you trade in smaller sample sizes, or a sample size where you don't lose an inordinate amount of money to find out it's not working. But you do this right, and you're the casino. Regardless of all the dynamic traders, regardless of all this other stuff I'm talking about, it doesn't matter. None of that stuff's important. As long as you understand how the underlying dynamics relates to the formula, so that you don't put an extraordinary amount of significance on a formula that's just giving you a pattern in collective behavior, not individual behavior. And it's individuals who move the market. So those individuals, there can always be an individual or group of individuals who come into the market that do something that completely negates the outcome of your pattern. And that's all right, because there's no way to know that in advance. It's all right. When you look at it that way, then you won't get all worked up. Then it's just a random outcome, just like a slot machine. It's just a random outcome. Because that's what you're expecting. You expect a random outcome, you got a random outcome, and there's no emotional significance. Because here's what happens when you don't look at it this way. Let's take a typical trader who's operating out of the 4 fears. Okay, we got support, we got resistance, we got a nice trading range. The market's coming down to support. Okay? Now, the typical trader operating out of those 4 fears, the fear of being wrong, the fear of losing money, missing out, depending on the intensity of these fears in a given moment, he might have a hard time putting that trade on. Right? He's got a viable pattern. All that happened here is that when the market, he had an imbalance in conviction. Remember, all price movements are a result of an imbalance in conviction. The markets came down to this point right here. There wasn't one person in the world, not one, I'm going to say this, not one person in the world, in the whole world, that would take out the bids to offer this market one tick lower than this price right here. Not one. Okay? And then all of a sudden there's an imbalance in conviction where there are more buy orders and sell orders that drives the price up to here. And the same thing happens, drive the price down to here. Same thing happens here, here. Now it's coming back down. Now, from my perspective, I'm looking at it like this. How much room do I have to give the market to tell me that the people who bought here and the people who bought here are going to come back into the market and do it again. Because right now there's an imbalance in conviction on the sell side. That means that enough orders, buy orders, have to come into the market to absorb all the offers, to absorb all those offers, with enough left over to create upside movement. Do I have any way of knowing whether or not they're going to come in? No, I don't. But the odds are in my favor. At least I hope they are. In any case, I'm willing to risk a certain amount of distance from my entry point to find out. That's all it means to me. If they don't come in, it means, you know what? The guys that bought here and bought here, they might be out to lunch. And that happens. I am not kidding you. I know that for a fact. I've experienced it. Because I intimately knew, a lot of the big traders in certain markets that would buy here. And I'm thinking, okay, they're coming back in, and they were out to lunch. Say, hey, where were you guys? But to the typical trader that doesn't think this way, what's going to happen? If he manages to get the trade on, it's going to be because he thinks he's right. It's because he thinks he knows what's going to happen next. Right? And he's not going to put in a stop, because to predefine his risk, how much money does he have to, how much room and dollar-wise, how much room, distance, of the dollar value of this distance that he has to give the market to tell him that this trade is either working or it's not. Or that to let it go any further isn't worth finding out. That's all it means to me. But he's not going to think that way. He's going to think, by gathering evidence that this trade might not work, he might be talking himself out of taking it. And so by the time he actually manages to get this order in the market and buy somewhere in here, he has convinced himself that he's right. Now remember I said earlier, and I think I just said it once so you might not have gotten it, that fear has an effect on the way we perceive information. When we're in a state of mind of fear, we are perceiving information in a threatening way. In other words, we're having an expectation of pain. And remember I said that to experience emotional pain, there's two kinds of pain: physical pain and emotional pain. Emotional pain requires an interpretation. The up and down ticks that the market offers us are not inherently pleasurable or painful by their nature. There is such a thing as painful information. I mean, painful from the environment's perspective. If someone's hurling insults at you, their intent is to cause you emotional pain. But that doesn't mean you're going to experience the emotional pain unless you interpret it that way. If they're hurling insults at you in a foreign language that you don't have the slightest idea about what they're saying, it may look to you like they're saying something that isn't so nice, but then again, you don't know what the words are, and so what do you feel? Nothing. The interpretations come from our beliefs. The interpretations come from our mental framework. In other words, the pain's already inside of us. All the words are doing is tapping us into it. Once we learn how to manage our interpretations, we can manage the way that we feel. We can actually determine how we feel in our own state of mind. So this trader, he's operating out of a fear of being wrong. So, like I said, he convinces himself that he's right. That's the way he gets the trade on. So let's say the market... Now, I said that fear causes us to focus on the object of our fear, so that we end up creating the very experience we're trying to avoid. This trader is trying to avoid being wrong. Now, we have self-protective mechanisms. They can work at an unconscious level. There are mechanisms inside of us that will protect us from information that we perceive as threatening. It causes what is typically referred to as perceptual blindness, where there are things going on around us that we cannot perceive, even though we have the ability to perceive it, but we're being blinded from it. if I'm afraid of being wrong, what of the information that the market is making available to me, what am I going to focus my attention on, the upticks or the downticks? You're right, the upticks, not the downticks. Meaning that what I will do is I will place an inordinate amount of significance. In other words, the way my mind will automatically weigh this information in terms of what's significant and what isn't, it will give more significance to the upticks than the downticks. Because every time I get an uptick, it will be taking me out of my pain. I'll say, oh, it's finally all over. And then we'll get more downticks. And then we get a couple upticks and say, oh, it's finally all over. In other words, what my mind is doing to protect me is saying that these few upticks are far more significant than all these downticks. Now, do I have the ability to recognize a trend? In other words, being able to define and recognize a trend is one of the most fundamental characteristics of learning technical analysis. A trend is a series of higher highs and higher lows, or lower highs and lower lows. But in this moment, am I able to recognize this as a trend? No, because I'm too focused on getting myself out of the pain, which means that I'm focused on these upticks. Now, our traders operating both out of a fear of being wrong and a fear of losing money. Now, what ends up happening is this, is that if this were to represent all the negative energy inside of his mind of what it means to be wrong, there's also negative energy inside of his mind about what it means to lose. And as the market moves further and further against his position, his belief about losing will start to gain more and more significance and start to rise to the forefront of his consciousness and make itself known, make its presence known, until finally he gets to a point where he cannot stand losing one more dollar. And that one more dollar, in essence, is when the pain of losing one more dollar is 1 degree greater than the pain of admitting that he's wrong. In other words, when this pain is greater than that pain by 1 degree, he'll get out of the trade. That's when he'll admit that it's a losing trade and get out. You guys with me on this? Now, he would say that the market did this to him. But what I'm saying is that is blatantly not the case. His fear did that to him. He created the very experience he was trying to avoid. He was trying to avoid being wrong, and he made himself wrong. And ultimately, this is always the spot where the market, where the market does that anyway. You guys with me on this? Okay. Now, this trader gets out of this trade right here. He looks back at this chart pattern, and why didn't I just go short? Why didn't I just go short? The ability to recognize this as a downtrend, or let's say he was blinded from his ability to recognize this as a downtrend. The distinction existed inside of his mind. In other words, he can actually make the distinction of what a downtrend is. But in that moment, while he was in that trade, he was blinded to his own distinctions. Because he was operating out of a trade-by-trade mentality. He was operating out of a trade-by-trade mentality. This trade took on the significance of life or death, just like any other trade that he puts on does. And to be a consistently successful trader, it ain't going to happen if you think that way. The pros don't think that way. Determine your risk. It either works or it doesn't, and go to the next trade. Determine your risk. It works or it doesn't, go to the next trade. That's all it is. That's the whole game. Now, let's say that this doesn't happen, but this happens. Let's say instead of it going against him, that the market does this. Now what ticks do you think he's going to be focused on, the up or the down ticks? The market's doing exactly what he wants, by the way. Now the market is doing exactly what he wants. And what ticks do you think he's going to be focused on? The down ticks. And why the down ticks? Because he's been in too many times of trades where the market has taken away his profits. And so he places an inordinate amount of significance on every down tick, and in essence ends up doing what? Leaving money on the table. So what he does is, let's say he gets out right here, so he cuts his profit shorts and lets his losses run. In Chicago vernacular, this is called shitting like an elephant and eating like a bird. What's that? Now, if this trader had a belief in a random outcome, that he didn't have to know what was going to happen next to make money, would he have these problems? What would he be expecting if he had a belief in a random outcome? That there was just a random distribution between wins and losses on any given set of variables that defined his edge. If he believed that, if he believed that it only took one trader somewhere in the world to negate the positive outcome of his edge, if he believed that no matter what reason he thinks he has for putting on that trade, that the reason why it works or it doesn't work will almost never correlate to the actual reason that he conjured up, if he believed all these things, how would he be handling this? Come on, how would he be handling it? Tell me.
Well, he would have a plan, or in my words, I like to use the word strategy.
Okay.
When he got into the trade, he's going to say that, okay, when it reaches this level right here, I'm going to get out. If it goes down to this level down here, I'm going to get out. Now, he may have ended up leaving some money on the table, but at least he's going to be in that percentage that he had already predetermined that's going to create him to be a winning percentage of trades.
Would he have be saddled with the same emotional problems that he had if he was operating out of a fear of being wrong or losing money? No,
because he didn't have any emotion in the trade. It's saying, hey, it's following my predetermined plan that I have in place.
Right. And it either works or it doesn't, right?
That's right.
Because I trade from a series of trades perspective. I don't know what each individual trade is going to do. This is the way the pros do it, by the way. This is thinking like a pro. You want to make consistent money, this is the way you're going to have to think. Otherwise, you already know what the problems are. Trading will take on a quality of being exasperating, because you can see the potential, and it seems like you're always just like that close from getting it, and you never get there. How we feel, our state of mind, in any given situation is always real and the absolute truth. Now, I want you to make a distinction here. At any given moment, we're in a state of mind. State of mind could be any number of things. We have a lot of ways to define states of mind. It could be a state of mind of like satisfaction, dissatisfaction, happiness, joy, fear, terror. These are all states of mind. Confidence is a state of mind. As a state of mind, confidence, when I'm confident, I feel compelled to step into a situation. Compels to thrust me forward into an experience. Of course, if I'm fearful, then what am I doing? I'm pulling back because I feel threatened in some way. I'm perceiving the information that's available in that moment as threatening. But you got to remember, for me to perceive it that way, it means I'm interpreting it that way. Here's where people get real mixed up about this sort of thing. Is that the state of mind that we experience in any given moment is always the absolute truth. You can't deny the fact that if I'm feeling fearful right now, then I'm feeling fearful. That's just the way that it is. I'm in that state of mind. The particular interpretation that got me into that state of mind, however, could be completely dysfunctional. You guys with me on this? The interpretation that comes from what we believe could be completely dysfunctional. You see, as passive technical traders, if we believe that somehow or another our methodology is telling us what's going to happen next on any particular trade, the reason why we're having problems is because that is a dysfunctional belief. It was never true.